Welcome to this deep dive. Today we're digging into something pretty crucial for international businesses, especially those with ties to Mexico. Action 3 of the OECD's BEPS project.
That's right. BEPS, base erosion and profit shifting. It sounds technical, but the core idea is simple enough.
It's about companies shifting profits to low-tax countries to reduce their overall tax bill, right?
Exactly. Exploiting gaps and mismatches in tax rules between countries. And Action 3, well, it specifically targets one way this happens.
Which is through controlled foreign company rules, or CFC rules. Okay, so what's the simple version of what CFC rules do?
Think of them as a tool for a country, say Mexico, to potentially tax the income of a subsidiary that one of its companies owns abroad.
Ah, okay. So if a Mexican company has a subsidiary somewhere with super low taxes.
Yes, and maybe that subsidiary isn't doing much real business, just holding on to profits shifted from elsewhere. CFC rules might allow Mexico to tax that income. It's about stopping profits from being parked offshore just to avoid tax.
So it aims to make sure the tax follows the actual economic activity, the real substance of the business.
Precisely. And that's what we'll explore today, the nuts and bolts of Action 3, why it matters for companies linked to Mexico, and, what the potential impacts are.
Great. So let's start with the problem itself. Why was Action 3 even needed? What's this profit shifting issue?
Well, the basic issue is that multinational groups can easily set up subsidiaries in other countries. These are the non-resident affiliates.
Okay.
And income can be, let's say, allocated or shifted to these affiliates. Sometimes that's for perfectly good business reasons, but
Sometimes it's mainly about the tax advantage.
exactly. The motive might be partly or even entirely tax-driven. They're using those differences in tax rules across countries to minimize their global tax burden.
Like our example.
Yeah.
A company here in Mexico sets up a shell company somewhere with zero tax, then arranges transactions to move profits there.
That's the kind of thing BEPS, and specifically Action 3's focus on CFC rules, aims to counteract. It's trying to realign taxation with where value is actually created.
Okay, I get the problem. So how do these CFC rules work in practice? What are they actually designed to do?
They basically give the parent company's home country the right to tax certain income earned by its foreign subsidiaries, the controlled foreign companies.
Under certain conditions, you said.
Yes, exactly. The key idea is to tackle income that's been artificially diverted to low-tax places where there isn't much real economic activity generating that income.
So if a Mexican company has that subsidiary, maybe in the Caribbean, and it's just holding patents developed in Mexico, Mexico might get to tax that patent income.
That's the principle. Before BEPS, some countries had no CFC rules at all. Others had rules, but they weren't really up to the job of stopping sophisticated profit shifting. Action 3 provides a kind of best practice framework.
A blueprint for effective rules. Okay, so what does Action 3 say makes these rules effective? What are the key components?
The OECD report lays out 6 main building blocks. First up is defining what a CFC actually is. And that hinges a lot on the concept of control.
Control, like who owns it, how much.
Pretty much. Often it's about ownership thresholds, maybe holding more than 50% of the shares or voting rights. But it's broader than just that.
How so?
Well, and also consider situations where maybe several shareholders who might be related or just acting together collectively hold control, even if no single one has over 50%.
Ah, like related parties within a bigger corporate group coordinating.
Exactly. The OECD notes that focusing just on related parties can simplify the rule, but might miss some structures. Still, since a lot of BPS structures do involve wholly owned or related party subsidiaries, that focus can capture many common scenarios. It's about effective control.
Okay, makes sense. What's building block number 2?
Number 2 is about CFC exemptions and threshold requirements. Basically, the rules shouldn't necessarily capture every single dollar earned by every foreign subsidiary.
Right. You don't want to create excessive burdens for tiny operations or genuinely active businesses abroad.
Exactly. So you might have exemptions, maybe a de minimis threshold. If the CFC's income is below a certain small amount, the rules don't apply.
Sensible.
Or exemptions might depend on, say, the level of tax the CFC is already paying in its own country. If it's paying a reasonably high rate already, maybe the CFC rules don't kick in.
So if the subsidiary is in a country with tax rates similar to Mexico's, maybe it's okay.
Potentially, yes.
Yeah.
Or if it has significant substance real operations, employees, assets in its location. But crucially, Action 3 warns against blending tax rates, like trying to average the low rate of a CFC with the potentially higher rate of a permanent establishment, or PE, to try and avoid the CFC rules.
Okay, keep things separate. Got it. What's the third building block?
This is a big one. Defining the CFC income itself. What kind of income are these rules actually targeting?
Right, because not all foreign income is problematic, presumably.
Exactly. The focus is on income types that are considered more mobile or susceptible to being shifted artificially for tax reasons.
Like what? What are the examples?
The OECD mentions things like passive income dividends, interest, royalties. Also, income from financial services, insurance, sales, invoicing activities, income derived from intellectual property, digital goods. Often, income that can be detached from the core value creation activities.
So things that aren't necessarily tied to a big factory or lots of local employees in the CFC's country?
That's often the characteristic, yes. Factors used to identify this targeted income include its geographic mobility, whether it arises from transactions with related parties, the source of the income, and crucially, the level of actual activity in the CFC. This brings us to substance analysis.
Substance analysis, you mentioned that regarding exemptions too.
Yes, it's key. How much real economic activity is actually going on in that foreign subsidiary? Is it just a mailbox company, or does it have offices, staff, decision-making functions?
And how does that analysis work?
Well, there are different approaches. It could be an all-or-nothing test. If the CFC meets a certain substance threshold, maybe none of its income is treated as CFC income.
Okay.
Or it could be a proportionate analysis. This is often seen as more aligned with, say, EU law principles. Here, you try to identify which part of the income relates to the genuine activity in the CFC and only attribute the rest, the part potentially lacking substance, back to the parent.
So the proportionate approach seems more targeted, maybe fairer, but perhaps more complex to apply.
That's the trade-off, yes.
Yeah.
It aims to only tax the income that doesn't seem justified by the actual activity happening there.
Understood. What's the fourth building block?
Rules for computing the income. Once you've identified that some income is CFC income, how do you actually calculate the amount that gets taxed back home?
Do you use the accounting rules of the subsidiary's country or the parent's country? Like Mexico's rules in our example.
Action 3 generally suggests using the tax rules of the parent company's jurisdiction.
Yeah.
So, yes, Mexico's rules in that case. This helps with consistency, especially for things like how losses are treated.
Okay.
Using the local CFC rules could introduce complexities and potential mismatches. Interestingly, some jurisdictions might allow the parent company to use its own losses to offset the attributed CFC income, though Action 3 notes this isn't a major BEPS concern itself.
Okay. Fifth element.
Rules for attributing the income. So you've calculated the CFC income according to the parent's rules. How does that income get assigned or attributed back to the parent company shareholders for taxation?
Usually based on their ownership stake, I imagine.
Typically, yes. It's attributed pro rata based on their shareholding in the CFC or perhaps the parent entity.
And the final building block, number 6.
Critically important. Rules to prevent or eliminate double taxation.
Yes. You can't tax the same income twice or you create huge problems.
Absolutely. You need mechanisms to provide relief if the income has already been taxed.
How could double tax arise here?
Several ways. The CFC might have already paid corporate tax on that income in its own country. Relief, like a tax credit or exemption, would be needed in the parent country.
Okay.
Or CFC rules in multiple countries might technically apply to the same income if ownership chains are complex. Coordination is needed.
Right.
Also, what happens when the CFC later distributes that income as a dividend? If it was already taxed under CFC rules, you need to ensure it's not taxed again when the dividend is received.
Makes sense.
And if the parent sells its shares in the CFC later on, the value of those shares might reflect retained earnings that were already taxed under CFC rules. You need rules to prevent that value being taxed again as a capital gain.
Lots of scenarios to consider.
Yes, and one more mentioned is interaction with transfer pricing. If there's a transfer pricing adjustment between related parties in two countries, that could interact with a CFC charge being applied by a third country, potentially leading to double tax without careful coordination.
Okay, so those 6 blocks provide the technical structure. What about the bigger picture, the policy thinking behind these rules?
Well, there are several key policy drivers. First, CFC rules are meant to be a deterrent. Their existence discourages companies from setting up artificial structures just to shift profits.
Makes companies think twice.
Exactly. Second, They complement transfer pricing rules.
Hmm.
Transfer pricing looks at the price of specific transactions between related parties. CFC rules provide a backstop, looking at the overall outcome where the profit ends up and whether it aligns with substance.
So two different tools tackling the same broad problem.
Correct. Third, there's that constant balancing act. Effectiveness versus administrative burden. Rules need teeth, but they shouldn't swamp businesses and tax authorities with unmanageable complexity and compliance costs.
A practical consideration.
Fourth, as we just discussed, balancing effectiveness with preventing double taxation. It's crucial. Fifth, the country's overall tax system matters.
Also,
Whether a country has a worldwide system, taxing global income of residents, or a territorial system, mainly taxing domestic income, influences the design and importance of CFC rules. Worldwide systems arguably rely more heavily on CFC rules to protect their tax base from erosion.
right, because they aim to tax that foreign income anyway.
Exactly. And finally, particularly for countries in Europe, EU law considerations can also shape how CFC rules are designed, especially around principles of non-discrimination and freedom of establishment.
Okay, that gives us a really solid understanding of Action 3 and CFC rules generally. Let's bring it home to Mexico. How relevant are these principles for companies connected to Mexico?
Very relevant. Whether it's Mexican companies operating abroad or foreign multinationals with subsidiaries in Mexico, the Action 3 framework provides a benchmark.
So for a Mexican company with, say, a subsidiary in a low-tax jurisdiction.
If Mexico strengthens or implements CFC rules based on Action 3, that company could face much more scrutiny of that subsidiary's income and activities. If the subsidiary lacks real substance, that income might become taxable in Mexico.
Even if it hasn't been paid back as a dividend yet.
Potentially, yes.
Sure.
That's the point of CFC rules taxing it when it's earned by the CFC, if it meets the criteria, rather than waiting for distribution.
And what about foreign companies with operations in Mexico?
Well, Mexico implementing robust Action 3 aligned rules could be part of a global trend. It affects the overall landscape these multinationals operate in. Also, Mexico's own rules will determine how interactions with subsidiaries in other countries are treated for Mexican tax purposes. It's all interconnected.
So it really pushes companies to ensure their international structures align with where their actual business happens.
That's the goal. It's important to stress, though, that adopting specific rules is up to each country. Action 3 is the recommendation, the framework, not a binding law itself for all countries immediately, but the direction of travel globally is clear.
Okay, so thinking about businesses in Mexico, what are the main risks and perhaps opportunities arising from this push towards stronger CFC rules globally?
Let's start with the risks. Definitely, increased scrutiny of offshore structures and those intercompany transactions is a big one.
Tax authorities looking more closely.
Yes. And that could lead to potential higher tax liabilities if existing setups are deemed artificial or lacking substance.
Okay.
There's also the risk of increased complexity in tax compliance and reporting. These aren't simple rules.
More paperwork, more analysis needed.
For sure. And fundamentally, companies might need to reevaluate and potentially restructure their international operations to ensure they meet these evolving substance requirements. That can be costly and disruptive.
Sound like significant challenges. Are there any upsides, any opportunities?
Well, potentially, yes, especially in the longer run. If countries widely adopt more consistent rules based on Action 3, could actually lead to greater clarity and tax certainty for multinationals.
Less ambiguity, perhaps.
Hopefully. It could also help create a more level playing field. If aggressive tax planning using low-tax CFCs becomes harder, companies compete more on their actual business merits.
That sounds positive for businesses playing by the rules.
It should be. And for Mexico itself, implementing effective, fair, and internationally aligned tax rules, including CFC measures, could potentially enhance its reputation and attract more genuine, substance-based foreign investment over the long term. Companies might prefer locations with clear, stable, and fair tax systems.
So short-term pain, perhaps for some, but maybe long-term gain in terms of a fairer, more predictable international system.
That's certainly the aspiration behind the BEPS project in Action 3.
This has been incredibly helpful, really clarifying what Action 3 is all about. It's clear that understanding these CFC rules is just essential now for any business operating across borders, especially with links to Mexico.
Absolutely. The global tax landscape is definitely shifting towards transparency and linking tax to substance. Action 3 is a major part of that shift.
So as we finish up, maybe a final thought for our listeners. How might this ongoing global implementation of measures like Action 3 really reshape international business strategies and investment choices over the next few years? It's worth thinking about the ripple effects on how companies structure themselves and where they choose to operate.
A very important question. And for anyone wanting the full technical details, the OECD's BEPS project reports are the place to go. They really lay out the thinking behind Action 3 and the other measures. It's complex, but definitely critical knowledge in today's economy.